Listen, the next market crash is not a question of if, it's a question of when. And if you're sitting here waiting for someone to ring a bell and tell you it's time to prepare, you've already missed the window. I've been through enough crashes to know that the people who survive them are the ones who prepared when everything felt fine. The people who lose everything are the ones who thought they had more time. I'm not here to predict the exact date. I'm not here to tell you the sky is falling. I'm here to tell you what I know from experience. Markets crash. They always have, they always will. And the crash itself is not what destroys wealth. It's the lack of preparation before it happens. Because when the crash comes, it's too late to build the life raft. You either have one or you don't. Now, most people treat market crashes like natural disasters, something that happens to them, something outside their control. And that's the first mistake. A crash is not something that happens to you. It's something you either survive or you don't, based entirely on decisions you made before it started. The market doesn't care about your intentions. It doesn't care that you were going to diversify next month or build cash reserves next quarter. When the selling starts, your portfolio is either positioned correctly or it's not. I've watched people lose decades of wealth in a matter of months because they didn't take this seriously. And it's not because they were stupid, it's because they were comfortable. Comfort is the enemy of preparation. When markets are going up, when your portfolio's growing, when everyone around you is making money, preparation feels unnecessary. It feels paranoid, but that's exactly when you need to do it. Because by the time it feels necessary, it's too late. Here's what I learned from every crash I've lived through. The dot-com bubble, the financial crisis, the COVID collapse. Every single one of them had the same pattern. Before the crash, everyone thinks it's different this time. They think the fundamentals have changed. They think the rules don't apply anymore. And then reality shows up. And reality doesn't negotiate. The people who made it through those crashes had something in common. They weren't lucky. They were prepared. And preparation is not complicated. It's just uncomfortable. Because it requires you to do things that feel wrong when everything's going right. It requires you to take chips off the table when everyone else is doubling down. It requires you to hold cash when cash feels like it's losing value. It requires you to hedge when hedging costs money. Most people can't do it. Not because they don't understand it, but because they don't want to miss out. So let me walk you through exactly what you need to do before the next crash. Not theories, not abstract concepts, specific actions that will determine whether you survive or get destroyed. The first thing you need to do is build a cash position. And I'm not talking about whatever's in your checking account. I'm talking about real liquidity. 6 months of expenses at minimum. 12 months if you want to sleep well. 24 months if you're serious about opportunistic buying during the crash. Here's why this matters. When markets crash, everything becomes a forced seller's market. People who need cash sell assets at terrible prices because they have no choice. People who have cash buy those assets at discounts. That's how wealth transfers, from the unprepared to the prepared. But you can only be a buyer if you have cash. And if you're fully invested when the crash comes, you're not a buyer. You're a victim. I know what you're thinking. Kevin, cash is losing value to inflation. Cash is a bad investment. And you're right. Cash is a terrible investment during normal times. But crashes are not normal times. During a crash, cash is the best performing asset you can hold. Because when everything else is down 30, 40, 50%, cash is still worth exactly what it was worth. And more importantly, cash gives you options. It lets you buy when others are selling. It lets you cover expenses without liquidating investments at the bottom. It lets you wait. Most people don't have cash because they're chasing returns. They see their cash sitting there earning nothing, and they feel like they're losing, so they invest it. They put it in stocks, in crypto, in real estate. And when the crash comes, they're forced to sell those investments at a loss just to cover their basic needs. That's not investing, that's gambling. And the house always wins when you're gambling with money you can't afford to lose. So here's the rule. Before you invest another dollar, you need 6 months of expenses in cash. Not in a brokerage account, not in bonds, in a savings account. Liquid, accessible, boring. And if you can't build that cash position without selling investments, then you're overinvested, which means you're already taking more risk than you can handle. And that risk is going to cost you when the market turns. The second thing you need to do is stress test your portfolio. And I mean actually stress test it. Not just assume it'll be fine, not just hope for the best, run the numbers. Here's how you do it. Take your current portfolio. Assume stocks drop 40%. Assume real estate drops 20%. Assume bonds drop 10% if rates spike. Assume your crypto goes to zero because it might. Now look at what's left. Can you survive on that? Can you cover your expenses? Can you sleep at night? If the answer is no, your portfolio is too aggressive, and you need to fix it now, not later. Most people have no idea how their portfolio would perform in a real downturn because they've never actually modeled it. They just assume it'll recover, and it probably will recover, eventually. But eventually doesn't pay your mortgage, eventually doesn't cover your kids' tuition, eventually doesn't keep you from panic selling at the bottom. You need to know with precision how much pain your portfolio can take, because if you don't know that number, you're going to find out at the worst possible time. I've seen investors with portfolios that looked great on paper, diversified, well allocated, solid returns. And then the market dropped and they realized they were holding too much risk in too few positions. They had concentration risk they didn't know about. They had correlation risk they didn't understand. And when everything dropped at once, their diversification didn't protect them because they were diversified across things that all moved in the same direction. So you need to look at your actual holdings, not your asset allocation, your actual holdings. If you own 10 different tech stocks, you're not diversified. You're concentrated in tech. If you own stocks and real estate in the same geographic market, you're not diversified. You're concentrated in that market. If you own corporate bonds from companies in the same sector as your stocks, you're not diversified. You're doubling down on sector risk. Real diversification means your assets move independently, and most people don't have that. The third thing you need to do is eliminate variable rate debt. All of it, right now. If you have a variable rate mortgage, refinance it to fixed. If you have a variable rate business loan, restructure it. If you have a home equity line of credit that can reprice, pay it off or lock in a fixed rate. Because when the crash comes, central banks respond. And when they respond, rates move. And if your debt reprices when you're trying to survive a market collapse, you're in trouble. I've watched businesses fail during downturns not because their business model broke, but because their debt service doubled. I've watched families lose homes not because they couldn't afford the original payment, but because the payment adjusted at the worst possible time. Variable rate debt is fine when rates are stable or dropping. It's a disaster when rates spike. And you don't get to choose when that happens. Fixed rate debt gives you predictability. It gives you a known payment. It gives you the ability to plan. And in a crash, planning is everything. Because chaos is expensive. Uncertainty is expensive. If you don't know what your debt service is going to be 6 months from now, you can't budget. You can't prepare. You're just reacting. And reacting is how you lose. Now, some of you are thinking, but Kevin, rates are already high. Refinancing now locks me into a bad rate. And maybe that's true, but you need to ask yourself a question. Would you rather have a fixed payment you can plan around or a variable payment that could go higher? Because if rates go up from here, and they might, your variable rate goes with them. And if you're wrong about that, the cost is catastrophic. Fixed rate debt removes that risk. And removing risk is the entire point of preparation. The fourth thing you need to do is reduce leverage across the board. And this is where people get defensive, because everyone loves leverage when it's working. Leverage amplifies returns on the way up, but it amplifies losses on the way down. And during a crash, leverage is what turns a bad situation into a terminal one. I've seen investors with great assets lose everything because they were over-leveraged. The assets were fine. The leverage killed them. Because when values drop, lenders call loans. When lenders call loans, you're forced to sell. When you're forced to sell in a down market, you sell at the bottom. And that's how generational wealth disappears. If you're using margin in your brokerage account, reduce it. If you're using debt to buy rental properties, make sure you can cover the payments even if the properties sit vacant. If you're using business credit lines to fund operations, build a cash buffer so you're not dependent on that line staying open. Because in a crash, credit disappears. Banks tighten. Lines get pulled. And if you're dependent on access to credit, you're one decision away from insolvency. I'm not saying don't use leverage. I'm saying use it carefully. Use it in amounts you can survive if everything goes wrong. Because in a crash, everything does go wrong, all at once. And if you're over-leveraged, you don't get a second chance. The fifth thing you need to do is identify what you'll sell and in what order. Before the crash, not during it. When markets are crashing, you can't think clearly. You're emotional. You're watching your net worth evaporate. You're seeing headlines about the end of the world. And in that state, you make terrible decisions. You sell the wrong things at the wrong time for the wrong reasons. So you need to decide now, while you're calm, what gets sold if you need liquidity. Make a list. Rank your assets from most expendable to least expendable. The things at the top of the list are the things you sell first. The things at the bottom are the things you never sell unless it's life or death. And then you commit to that list. Because when the crash comes and you're panicking, you don't have to think. You just execute the plan. Most people do the opposite. They sell whatever's easiest to sell or whatever's down the least, and that's backwards. You should be selling the things that matter least to your long-term wealth, regardless of whether they're up or down. If you have an investment you don't believe in long-term, sell it now. Don't wait for the crash. If you have an asset that's speculative, sell it now. Don't hope it recovers. Hope is not a strategy. The goal is to simplify your portfolio before the chaos starts, because complexity kills you in a crash. The more positions you have, the more decisions you have to make. The more decisions you have to make, the more chances you have to screw up. Simple portfolios survive crashes. Complicated portfolios get destroyed because their owners can't manage them under pressure. The sixth thing you need to do is prepare for income disruption. And I don't care how secure you think your job is. In a crash, nothing is secure. If you're employed, assume you might not be. If you're a business owner, assume revenue is going to drop. If you're retired, assume your portfolio withdrawals might need to stop for a while. And then plan for that scenario. What do you cut? What do you keep? How long can you survive without income? If you don't know the answer to that question, you're not prepared. I've watched people with seven-figure portfolios lose everything because they couldn't adjust their spending when their income disappeared. They kept spending like nothing changed. They kept pulling from their portfolio. They kept living the same lifestyle, and their portfolio couldn't handle it. It wasn't the market that destroyed them. It was their inability to adapt. So you need a plan. If your income drops by half, what changes? If your income disappears completely, what's the bare minimum you need to survive? And can you get to that number without destroying your investments? If you can't, you need to make changes now, because waiting until the crash to figure this out is too late. The seventh thing you need to do is secure alternative income streams. Plural, not one, multiple. If all your income comes from one source, you have a single point of failure. And single points of failure are catastrophic in a crash. If you lose your job and that's your only income, you're in crisis. If you're a business owner and that business fails, you're in crisis. But if you have multiple income streams, losing one is painful but not fatal. This doesn't mean you need to start 10 side hustles. It means you need to build redundancy. If you have a job, maybe you also have rental income. If you have a business, maybe you also have dividend income from investments. If you're retired, maybe you have part-time consulting work you can activate if needed. The point is diversification, not just in assets, in income. Most people don't think about this until it's too late. They optimize for maximum income from one source instead of stable income from multiple sources. And when that one source disappears, they're scrambling. Don't be that person. Build the redundancy now. Because once the crash starts, opportunities to create new income streams disappear. Now let me address the objections, because I know what you're thinking. You're thinking, Kevin, if I do all this, I'm going to miss out on gains. And you're right, you might. If the market keeps going up and you're holding cash, you're going to underperform. If you reduce leverage and the market rallies, you're going to make less. If you sell positions to simplify your portfolio, you might sell something that ends up going higher. And all of that is true. But here's what you need to understand. Preparation always underperforms during good times. That's the cost. That's what you pay for safety. And the question you need to ask yourself is, what are you optimizing for? Are you optimizing for maximum gains in a bull market? Or are you optimizing for survival across all market conditions? Because if you're optimizing for maximum gains, you're taking a bet. You're betting the market keeps going up. You're betting the crash doesn't come yet. You're betting you'll see it coming and have time to react. And maybe you're right, but if you're wrong, the cost is everything. Is that a bet you're willing to make with your family's financial future? I'm not. I've made too much money and lost too much money to think I can time markets perfectly, so I don't try. I prepare. I position myself to survive the worst and participate in the best. And that means I give up some upside. But I sleep well, and I'm still here after multiple crashes. Most people can't say that. The other objection I hear is, this sounds like market timing. And I don't believe in market timing. And you're right, this is not market timing. Market timing is trying to predict the exact top and bottom. This is risk management. This is positioning yourself so that when the inevitable happens, you're ready. There's a difference. Market timing says, I think the crash is coming in 3 months, so I'm going to sell everything now and buy back later. Risk management says, I don't know when the crash is coming, but I know it's coming eventually, so I'm going to build a portfolio that can handle it. One is a prediction, the other is preparation. I don't do predictions, I do preparation. And here's the thing. If you do everything I just outlined and the market doesn't crash for 5 more years, you're still fine. You'll have cash, you'll have a stress-tested portfolio, you'll have fixed-rate debt, you'll have multiple income streams. You'll be in a stronger position than you are now, even without a crash. So there's no downside to preparation except opportunity cost. And opportunity cost is the price you pay for not losing everything. Let me tell you what happens if you don't do this. If you ignore this and the crash comes, here's how it plays out. First, the market drops. Fast. 30% in a matter of weeks. Your portfolio, which was worth $1 million, is now worth $700,000. You tell yourself it's temporary. It'll recover. You've been through this before. But this time feels different. The headlines are worse. The fear is real. And you start to panic. Then the margin calls start. If you're using leverage, your broker forces you to sell. You don't get to choose what or when. They liquidate your positions at the worst possible time. Now you're down 40%, and you're locked in losses. Then the income disruption happens. Maybe you lose your job. Maybe your business revenue craters. Maybe your rental properties stop paying because tenants can't pay rent. And suddenly, you need cash. But you don't have cash because it's all invested. So you're forced to sell. And you're selling into a falling market. You're getting terrible prices. But you have no choice. You need to eat. You need to pay your mortgage. So you sell. And now you're down 50%. And the recovery starts. But you're not in it because you sold. You sold at the bottom because you had to. And you watched the market come back without you. And that's how decades of wealth disappears. Not because the market crashed, but because you weren't prepared when it did. This is not hypothetical. This is what happened to millions of people in 2008. This is what happened in 2000. This is what happened in every crash. The people who lost everything weren't unlucky. They were unprepared. And the people who made generational wealth weren't lucky. They were ready. So you have a choice. You can prepare now when it's uncomfortable but possible. Or you can wait until the crash forces you to prepare when it's too late. Most people wait because preparing feels like you're giving something up. But what you're actually doing is protecting everything you have. And that protection is worth more than any gains you might miss. I've been doing this long enough to know how this story ends. The people who survive crashes are the ones who took this seriously before it happened. The people who don't are the ones who thought they had more time. And time is the one thing you can't get back. So look at your portfolio, look at your cash, look at your debt, look at your income, and ask yourself, if the market dropped 40% tomorrow, would I be okay? If the answer is no, you know what you need to do. And you need to do it now. Not next month, not after the next rally, now. Because the next crash is coming. It always does. And when it gets here, the only thing that matters is whether you prepared or not. Everything else is noise. If this made sense to you, subscribe, because I'm going to keep giving you the information you need to protect your wealth, whether it's popular or not. And if you want to understand what to do during the crash when it actually happens, watch the next video. I'll see you there.